Look, I really think it's really just a supply and demand imbalance right now. The front end of the market has been, extremely stressed. So there has been a demand for short-term collateral. And now we have to think about the markets in terms of leverage and also funding and fungibility of assets. There's probably nothing more liquid than a short-term Treasury bill, and in markets like this where you need liquidity, because that's what has been stressed. It's getting better, but that is what has been stressed, that there's going to be a lot of demand for this short-dated paper.
Is there going to be enough demand for all Treasury paper going forward now that we're talking about running a 15 to 20% deficit and having to do a ton of new issuance?
So that's a really important issue, and I think what Ben Bernanke was referring to as he was discussing this is that, look, the first thing that starts to break whenever you move into a crisis is the liquidity conditions in the market. And we go through a period of illiquidity. And the Fed has done a lot so far to address that. They fixed the repo market in many ways. They've increased liquidity for Treasuries through quantitative easing. And today's a great example. The Dow's up 1,000 points and 10-year Treasury yields are down 5 basis points. So I think that the monetary policy transmission mechanism to keep yields low as a stimulus is a good thing right now. But in terms of demand down the road with fiscal deficits that are going to be rising and certainly rising aggressively after all the stimulus that gets passed through, that's a good question. I would argue that for the time being, it is the Treasuries will stay in good demand. Maybe a year down the road or 2 years down the road, there might be a different story. But this is a relative game. I mean, we can look at where other bond yields are trading around the world as well.
Right. So, Jim, do you think the most likely outcome here, if we fast forward a year or two, is that we have more negative yields on U.S. Treasuries or much higher yields because people have this concern about supply deficits, maybe even inflation and some kind of recovery?
So I don't think we have negative yields. I feel very confident to say that, because this is really just a liquidity and collateral demand issue. This is a technical. In terms of if we get the kind of recovery that a lot of people are talking about, which is more of a gradual U-shaped recovery, and we return to some normalcy a year to 18 months down the road, I still think the Fed funds rate is going to be at zero. I think they're going to be at zero until the end of 2021. This may, with all the stimulus that's in the system, what we have to recognize is that the stimulus that comes into the system has a degree of permanence. It's going to stay here for a while, even as things improve. We're going to restore the inflation risk premia. At least that's what the Fed is trying to do. So I would argue that 10-year Treasury yields, stay, around these levels to maybe slightly higher in yield, and the yield curve stays reasonably steep. And I think that's part of the goal for the Fed. A 0 10-year yield does no good for anybody. So you do have to have some yield in the market and some slope to the curve, and that'll certainly help the financial system. And I think that's going to be part of the plan. And I also think that inflation risk premia will start to rise, but this is we're talking 2 years out, year and a half out, not anytime soon.
Yeah, no. What sticks in my mind is the permanent stimulus that you just referenced. That's food for thought. Jim, thanks so much.